Welcome to the Multifamily Dispatch. I'm Dan Gable, CEO of J+G Companies, and I'm joined by Dr. Matt Bastnagel, our Director of Marketing and Research. Hello. Matt, what are we going to talk about today?
Oh, well, do you even have to ask? Of course, we're going to talk about Kevin Warsh's spectacular debut as the chair of the Federal Reserve Bank and how he's going to steer the economy in just the right direction. And of course, we're also going to talk about this year's State of the Nation's Housing Report from the Harvard Joint Center of Housing Studies. We also have an update on the affordable housing market from Yardi Matrix that pairs well with that Harvard Housing Report. But let's cut to the chase and talk about what everyone wants to hear: Kevin Warsh's dramatic, attention-grabbing entrance as the new chairman of the Federal Reserve. Dan, what happened and what does it mean for investors?
Well, it certainly was dramatic. He put the market on notice that we've got the Kevin Warsh from the great financial crisis. The Kevin Warsh who is an over-the-top inflation hawk.
Yeah.
The Kevin Warsh we thought we might get, but not the Kevin Warsh that Trump thought might lower interest rates. I mean, what a bait and switch.
Yeah.
If he was looking for a nickname, I think he earned one at this press conference. How about this? Task Force Warsh.
I love it.
It kind of rhymes,
Yeah,
if you say it right. So we saw Task Force Warsh. We saw his true colors at the press conference following his first FOMC meeting as chairman. And again, he sure looks like the hawk he was back in 2007.
Yeah.
He is who we thought he was, right? Just look at his background, and he's going to behave that way. Here's more or less what we heard and how we think it'll impact multifamily investors and in our business. So higher for longer might be turning into higher forever, at least, for the next several years. He's not going to mess around. And after taking some shots at his predecessor for not whipping inflation over the last 5 years, he's reiterated his passion for crushing inflation as if it was this directive from on high. He used the word task force 16 times in the press conference, showing the market and the media how he wants to go about reshaping the Fed.
Is a task force like a blue ribbon committee?
I don't think so.
Committee.
He's forming these 5 task forces: communications, the balance sheet, data, productivity, the inflation framework.
Sweet.
I just want to dive into 2 of them.
Right.
Okay. First off, he wants to review the communication strategy that the Fed has been using for the last 20 years. Yeah, I posted this yesterday on LinkedIn because I thought it was the most logical and well-articulated explanation for why reducing communication from the Fed might make sense. So basically, he wants the Fed to react to the market rather than the market reacting to the Fed.
Yeah.
And this is important because his stance is that the market essentially crowdsources data and answers in real time, whereas the Fed traditionally uses government-backed data that goes backward, that is backward looking, and has, 3 or 4 revisions. At the bottom line is he's cognizant of the Fed's impact to the markets. And when the market's hanging on the Fed's every word, is that the way a market should function?
Yep.
Right? That's the question. And as a free market supporter, I kind of like his idea of flipping the table to back 20 years ago, pre-GFC, when, the Fed listened to the market, not the market listening to the Fed. The other way around. Speaking of backward-looking data, he wants to review current stats, the data that's used by the Fed, and compare it to best practices from private sources. He notes that private businesses like ours, run their business based on real-time data, not historical lag data that comes with these revisions months later. And he thinks that the Fed may be able to adopt a few new data sources from the public sector to better inform their policy.
Yeah, I'd agree with this too. And I think they shouldn't limit themselves to public sector data. Maybe take in some private sector data, but tell us about it.
Yes.
Don't just meet in some dark room and then, maybe we'll see like white smoke or whatever they have, like a conclave. I don't think they need to act like that closed off, but incorporating new data sources is really useful.
Yeah, I think so too. And kind of modernizing the data that they're using and the data collection techniques, I think will be useful.
Yeah.
Right. He believes in the power of and. Okay. And, if any listeners are familiar with the book Built to Last by Jim Collins, this is a mindset that's found in the cultures of highly successful companies. Basically, choices don't need to be one or the other. Rather, they can be this and that, right? It's relevant for the Fed because the mindset is often that the Fed's dual mandate of full employment and stable pricing are in conflict with one another.
Yeah.
Mr. Warsh stated that he doesn't believe in the, quote, cruel choice between jobs or inflation. He believes the Fed can accomplish a goal of strong growth and low prices, which is really easy to say and much harder to pull off.
That's a tick in the low interest rates column, I think.
Well, I don't. I think what he's saying is
that he can keep them high and employment will still be high.
Yes, that's exactly right. We can keep interest rates a little higher, employment will stay higher, or perhaps a short-term unemployment pop is worth sacrificing for whipping inflation.
Okay,
right. Actions speak louder than words, and I think this is the same Kevin Warsh from 2007. I think, like I just said, he's willing to sacrifice jobs in the short term to beat inflation. He reiterated routinely in the press conference the goal of reaching 2% inflation, and he felt that productivity from AI growth would ultimately offset job loss. I think the jury's still out on that. It's clear that this is not the guy who just a few months ago was adamant about lowering interest rates.
Yeah.
Now that he has the appointment, his true colors are showing.
And Trump appointed Jay Powell didn't exactly follow the script.
That's exactly right. I think this means that there's, this is the new normal, higher forever, or at least for the next, few years. So bringing it all to housing, right? When asked if he felt current rates were restrictive, he said he felt like they were restrictive in some areas, and specifically mentioned housing, but also hinted at rates being unrestrictive in financial markets. Okay. So, we focus on housing here at the Multifamily Dispatch and here at J+G Companies, and so we think rates are restrictive too. So what are you going to do about it, Mr. Warsh? If you think rates are restrictive on housing, it sounds like nothing.
One easy solution, I don't know.
It sounds like nothing. It seems like the Fed is now focused on house cleaning, task forces, remaking the Fed the way that Mr. Warsh sees fit. So what? What does this mean? Well, either home prices will come down as demand and affordability remain challenged with higher rates, or home prices will stay elevated and out of reach for many, would-be home buyers who will otherwise be renters.
Yep.
Borrowing costs to build new apartments will remain elevated, and borrowing costs to purchase existing communities will also remain elevated. I think this keeps cap rates elevated as compared to the early 2020s and makes building new supply more difficult. What do you think, Matt?
Yeah, no, I think you nailed it there too, especially just as a way to anticipate whatever further moves he might make. It's not going to be anything too hasty, and he certainly didn't really provide a whole lot of evidence for any kind of rate cut anytime in the future. People were speculating on this even before, and they didn't need any dot plots to figure this out. A couple weeks ago, we were talking about how if you go on the Fed Watch tool, they are anticipating some rate hikes by the end of the year. So I'm a little bit skeptical of how effective it's going to be to kind of cordon off communications. Let's look at the dot plot for this week and the summary of economic projections. The dot plot from the Federal Reserve is a way that the Federal Reserve officials visualize where they think the federal funds rate is going to be. They still have to vote on it, but it's each member's thoughts on where it will be or where they think maybe it should be. 19 members. It doesn't map perfectly with the Board of Governors, but there's 19 Fed officials that make up these dot plots. And in this month of June 2026, there were only 18 dots, Dan.
Who was missing?
One lonely dot missing from the rest. Kevin Warsh didn't put a dot in there. The quote is, "I did not submit a dot for me. It's not helpful in the conduct of policy." Translation, I'm not playing your silly dot games. Oh, did you like the pathos I brought to Kevin Warsh? I'm going to have to really work on my imitation there. But the fact that we've got 18 other dots there, that's a stark reminder that there is more than just one person at the Federal Reserve that's making all these rules. It's a board that votes. And one of those board members is our good friend, Jerome Powell, who, like I mentioned, I was talking to you earlier before we started recording. I bet it's like the guy that puts in his 2 weeks at work. He's relaxed. He's like, he doesn't have the responsibilities. He can kind of sit in the back of the classroom and be like, okay, so what do we do, Kevin? What's your move? What are you going to do? Uh, yeah, so I think it's going to be hard to stifle all the communication from all Fed members, whether it's Jerome's back of the classroom. I call him Jerome. I should say Jay, right? But yeah, it's going to be hard to stifle all the communication, whether it's in the dot plots or just like when they give remarks somewhere. I think that when people complain about the Fed too, it's less about what they say and more about what they do. And what they do is, well, they lower or raise interest rates, essentially. There was this whole argument in 2021 and 2022 about whether the Fed lowered interest rates too much for too long and that it made inflation worse. It was that act of lowering the interest rate. I think that was the big thing that people were actually complaining about.
It could be, though, Matt, sorry to interrupt, but it could be, the trillions of dollars that we dropped on the economy, and not so much the rate policy.
Yeah, exactly. Yeah, I know. There was a lot of factors in that equation too, and that was, I'll put those gripes to the side. Poor Jerome Powell, again, like he had a tough job.
He did have a hard job.
And people complained that Jerome Powell was calling inflation transitory. But I contend that this is only because the actions of the Fed keeping interest rate low and less because of the words. I don't think people are combing back to Fed projections and be like, hypocrisy. I can't believe you said one thing and you did another. No, they're really more in tune with where things are going to go at the moment. And they are very of the moment in terms of like, they're not really looking backwards. These people that are in the, whether it's making up the Fed Watch tool or the futures markets, their heads aren't stuck in the past at all. Mm-hmm. And so they'll take anything. But I do wonder if Kevin Warsh still thinks about the phrase transitory inflation, and he says to himself, "I'm not going to let that happen to me." If there's one word, if there's one phrase that people remember from the Fed in the past 5-7 years, it's transitory inflation. And maybe Kevin's like, well, I'm just not going to say anything at all. I'm not going to get in that problem. But easier said than done. And people care about what's done a lot more than what's said.
Completely agree. And we'll see what things look like in 6 weeks at the next meeting. Mm-hmm. So, turning from the Fed, because they're not going to say anything for the next 6 weeks. Yeah. Let's turn to housing.
Oh, good. Great. We've got enough to say here, too. From the Harvard Joint Center for Housing Studies, their State of the Nation's Housing 2026 just dropped just this week. And there's plenty to talk about, probably even more in the report, obviously, than we can cover everything. So I'll just kind of touch on things that are multifamily specific. Then we can go over some of the larger takeaways from the report itself. I've been reading these reports every year, and I know these reports have viewed the housing market through the lens of affordability. That's one of the assumptions that it's safe making about the Harvard Joint Center of Housing Studies, all the work that they do. That's top of mind. That's a big priority for them. And that's completely understandable. So I was ready to call out how, after years of these reports focusing on rents being unsustainably high, how now we're finally seeing them take a clear look at how rents have stagnated or even softened throughout the years. So now they're actually talking about rent growth remaining stalled. And here's on the screen here, it says rent growth remains stalled. That's their headline here in 2026. So that's the shift that I was actually looking for. I was like, finally, they're getting the picture. You didn't know about it now. You probably used CPI data, and you're not using, the private market data sources that we know and love on the multifamily dispatch. But I was kind of wrong, and it was a little more complicated than I thought. And it's not necessarily like this realization or inflection point from the Harvard Joint Center for Housing Studies, because if you look at back the past 4 years of the State of the Nation's housing and follow trends there, the truth is that they flagged this cooling rent growth in 2023, but they just didn't consistently focus on it in the following years. 2023 led with softening rent demand, historic supply wave. I think they noticed it. And I'm a little gratified that they noticed it that early. Great. At least someone did. Felt a little lonely when when no one noticed it. But then in 2024, it shifted back to renter cost burdens as the focus of their coverage of the apartment market. In 2025, they also led with rental unaffordability, with a later note on surging rental demand, which was kind of surprising because we're still in the same situation roughly that we were last year. Mm-hmm. But this year now, the headline is rent growth remains stalled. Oftentimes, past years will include the information on the cooling rental market, but you can tell where they're aiming their focus and priorities by these headlines and how many lines they'll write about one subject compared to another. And I just think it's important because this is a reflection of one slice of the public of how they are, getting their information. And this is an influential report itself, so you can kind of track the zeitgeist a little bit by seeing what they're paying attention in this report. Obviously, the Multifamily Dispatch has its own impact, and we try to issue our corrective opinions when we can.
That's right.
So yes, in sum, they knew about the oversupply apartment dynamics that had rent growth trending down all the way back in 2023, but they really didn't bring it up again prominently until 2026.
Mm-hmm.
There's another big area of apartment housing that our market rent growth trackers do not touch, and this in part it has driven the shifting attentions from the Joint Center of Housing Studies, and that's affordable housing, that capital A affordable housing, the kind of housing where government provides an extra incentive for builders to build the building. But there's rules about how much rent you can charge, often based on a certain percentage of area median income. We'll dig into these developments when we talk about the Yardi Matrix Affordable Housing Report. But even in this report from the Harvard Joint Center of Housing Studies, it's quite clear that the market rate housing and affordable housing, again, capital A, are taking diverging paths. This K-shape is pretty prominent, and it's almost to the point where there's kind of like a demand floor on affordable housing, and there is a striking shortage in that lower K than there is on the top part of the K, where the new buildings are all going to be really nice. You have to do certain things, and you have to build it in a certain way to make it open to lower income. And there's a lot of challenges there that we'll cover in just a second. So yes, I don't want to diminish the Harvard Joint Center of Housing Studies coverage of cooling rent growth in the apartment market. And they actually do talk about more things than just like it's lower rents or higher supply. They call out lower household formation, weaker labor markets, lower consumer sentiment, student loans, and low immigration as some of the reasons for the reduced demand for apartment rentals. But they also note the very same regional differences that we have noted in the Multifamily Dispatch.
Wait, are you talking about how the Midwest is the best?
Yes, they didn't say it, but I know what they meant. The specific quote is, asking rents fell in most southern and western markets. Indeed, rents dropped in 65% of markets in the South and 59% of those in the West, leading to overall regional rent decreases of 2.1% and 0.4%, respectively. Meanwhile, rents continue to climb in the Midwest, up 1.9%, and the Northeast, up 0.8%, increasing in more than 80% of markets in those regions. The strongest rent decreases were in previously hot Sunbelt markets, where rents rose most quickly during the pandemic. Likewise, vacancy is up in all regions except for the Midwest, where it's stable. We already know all this, but it's just nice to hear it from the Harvard Joint Center of Housing Studies. Additionally, going back to that K-shaped divergence between affordable housing and market rate housing, there's been an increase in higher income renters, which with 3/4 of the new apartment rental population making $75K or more a year, a development that the report says is driven by the high cost of home buying. But the number of cost-burdened renters are also up, particularly in larger cities. Zooming out from the rental market specifically, let's get to the larger takeaways of this report. We'll include a link to this in the show notes, but there are 10 takeaways. I'm not going to cover them all, but we'll cover the ones that I like. Housing activity remains subdued. This one is striking, and it's important to talk about. We've talked about this just recently in the Multifamily Dispatch, how it's not just rental markets, but for sale markets are getting more subdued. And this is a relatively new development. Maybe a couple of years ago, the for sale home market was doing pretty fine, but in throughout 2025, it got a little weaker, and now really in 2026, we are flirting with maybe crossing from home price growth to home price shrinking or decreasing. So I think that's a very, it's both interesting and worthwhile that they're pointing that out, especially because they're talking a lot about affordability. It's kind of interesting. So housing activity remains subdued. Meanwhile, affordability pressures remain. That kind of complicates the story in an interesting way. Weaker demand for housing now is a larger factor, which is also new. It used to be a supply story, but now we're looking at all those messy reasons for lower demand, whether it's lower consumer sentiment, labor market issues, or immigration. I think immigration is a big deal. And I know one thing, an immigrant comes in, usually they don't come in as a child that's unable to rent. They come in and they're usually renting age, and a large portion of them become renters and not home buyers. I'm curious, of new renter population, what percentage is from immigration typically, and what percentage is now? Because I know it's lower now. They're at least calling that out in a general way in the report. There's also that big regional story that we've talked about. We know all about this regional story. We talked about it before. They built more housing in the South and West. This has made housing cheaper in those areas because usually when supply goes up and demand stay the same, price go down. We have some nice maps we'll look at right now, actually, with that in mind. And this first one is the home price to income ratios near record highs. That's the title, and it looks at the home price to income ratios for markets throughout the nation, and it's color coded with the darker blues as ones with the lower price to income ratio, which is under 3, and 8 times and over. This is the price of the home, right? Is 8 times the price of your annual income or more. 3 times is still a lot for something. Well,
Yeah.
right. All right. Anyways, and there are still markets in 2025, like let's say Morgantown, West Virginia, or Peoria, Illinois, 2.2 times the area median income. So it's not impossible to find lower home price to income ratios, but guess where you're going to look to find them? The Midwest.
Oh, it's not the Midwest. That's it.
Oh, that was
That's
perfect.
the answer.
You could have got it better. Yeah, you're going to find them in the Midwest. And what I also like about this is this map has a little slider, and you can go back in history to 1980, where almost a whole nation was under 3 price to income ratio.
Yeah, that's incredible.
There were some, let's say Santa Maria, Santa Barbara, San Diego, and in San Francisco where things were more expensive, and in Naples. But by and large, it was pretty uniform that it more affordable housing, and there wasn't even any apparent regional differences aside from your San Franciscos and your Napleses. But then as you go, you can see, and you draw the slider and you go in the future. So from 1980, and then things really start shifting in the 2000s. And of course, they definitely start shifting post-pandemic, where you see it very clearly on the East Coast and the Southeast, and on the West Coast. It's it's a lot more expensive to get a house. And it is less expensive in the Midwest. Now, there's actually, you could argue that it extends down through like Oklahoma, Arkansas, and in parts of Texas, but I would say it's mostly in the Midwest.
But even the Midwest is less affordable than it
for sure.
was in the 80s.
Yeah.
Now,
they're not spared.
And if you drag that, what do you call that? Dragger?
A slider.
Slider. We'll call it a slider. If you drag the slider backwards and forwards, I wonder if you can trace debt costs. Over time, and see, the influence that low interest rates has on asset prices.
Yeah, that's a good point. So like 2020, 21, okay, interest rates go down. Interest rates go down from 20, and then 21. Things get a lot more hop during those periods. Yeah.
Yep.
That's super
and
interesting.
if you go backward, you can see
Any
it.
key years you want to see.
I mean, if you go backward into the GFC, right?
Yeah.
You can see it happening, right? Okay, California.
Oh wow.
And then
boom.
7? Yep, 07 and then 08, right?
Yeah.
Dang. Now we've got major economic catastrophe.
Yeah.
So housing values dropped tremendously, right? So
that's super interesting.
It begs the question, what do the next 5 years look like on this slider, right? So if interest rates stay high, does housing get more affordable?
Yeah.
I think it does.
Maybe that's what Kevin Warsh wants. And that's a lever. Obviously, let's do it. Okay. No, let's not. Kevin Warsh, it rhymes with, what did I say? Slower interest dates.
That's it. Yeah.
There's another map here that I wanted to mention here, and this is just we don't get the time slider, but that's okay. It does represent the cost burdens for renters, owners, and all households. Now, they also separated by the people that are merely cost burdened and severely cost burdened. When I was looking at this, I was like, are the regional patterns as apparent when it comes to the affordable class, right? The capital A affordable, or just like the people that really need housing, because that's this lower section of the K. What I noticed, what it seems like is it's a lot more evenly distributed throughout the country. The people that are cost burdened, you can see, yes, it does seem like they are relatively more cost burdened in the South and in the West, but it isn't as stark as it was, when we were looking at the price to income ratios. Now that's just the cost burden, and it's just for the renters. If you look at the owners, actually seems like a little more of a stark difference, where the housing is just more affordable in the Midwest compared to the East Coast, the South, and the West. Now, if you go to the severely cost burdened, I think it's a little more interesting. It's harder to see a clear pattern. It seems like they're all a little bit in trouble. And the same thing for the owners, where that number is, there's actually less severely cost burden among homeowners. But again, I think the larger point here was that, yes, there can be price differences and more affordable housing in the Midwest, but for the lower income portion, the people that are really cost burdened, it doesn't matter as much where you go. You're going to be pressed to find affordable housing no matter where you are. So that was my general point here. And we still need to build that more affordable housing. And to that end, as the report notes, there's an increase in LIHTC tax credits for affordable housing that Congress passed recently. They only mentioned the Road to Housing Act once in the Harvard report, but that's maybe because it's still kind of working its way through Congress. It may be voting on it right now in the Senate. I'm not sure, but it's a little bit of the end stage of them hashing things out. So we'll talk about that when they pass that. But on the other hand, HUD has recently recommended that public housing authorities stop issuing new vouchers and explore other cost-saving measures to ensure appropriations last through 2026. So there's a little bit of tight-fistedness in some of the federal affordable housing programs. And it's not as uniform of a support as one might think. And that is actually also echoed in the Yardi Matrix Affordable Housing Report. Before I get to the Yardi Matrix Report, I'm going to talk about some of those, just to add a little to the demand drivers. The National Low Income Housing Commission has their report on, it's called The Gap. It's the shortage of affordable homes. I guess they do this every year, and it is the amount of homes needed for extremely low income households, and their headline number here is 7.2 million. Now, last year it was at 7.1 million, and the year before that it was 7.3 million. So
how is it that we have fewer affordable houses yet 2 million fewer people?
Yeah, it could be income differences for the lower half of the population, but it's also, I think that affordable housing just moves in different trends than market rate, your other kind of movements. But there is that fluctuation. It seems to be hovering around 7.2, 7.3. So 2 years ago it was 7.3, then it got down to 7.1, and now we've lost some ground and it's back to 7.2. The Gap report also has some thoughts about the idea of like filtering, where you buy nice new Class A apartments, and that makes the nicer apartments cheaper to rent, and then it makes the a little less nicer apartments cheaper to rent, and it filters down through Class B, C, and other more affordable apartments. Their quote here, though, is the extent to which the filtering process benefits lower income renters in a particular time or place, however, is partly influenced by the tightness of the market, changes in demand, and owner behavior. Since 2015, downward filtering rates have slowed significantly and even reversed in some urban areas. So even when downward filtering occurs, relative rents at the bottom of the market that fall too low may incentivize owners to neglect or abandon their properties, ultimately reducing the benefits of filtering for the lowest income renters. So there's, again, like that lower area of affordable housing, there's different incentives, and it's just a different world with different pressures on renters and on owners than market rate housing. So it's nice to be able to have this report from the National Low Income Housing Coalition, as well as this report from Yardi Matrix that has some more information about the supply trends for affordable housing. Supply growth is decelerating a little bit, according to this report from Yardi Matrix. Affordable housing supply is still increasing at a healthy clip, but it's down about 20% in Q1. The starts in Q1 2026, that could change, but higher operation and construction costs have hit the affordable housing space, just like the market rate space. But sometimes it's not just a lack of funding that's preventing more affordable housing from being built. The quote here is, there are complications that could stymie growth in affordable development. Government programs are often slow to translate into actual construction. All deals remain subject to the same construction timelines, delivery risks, and cost pressures as market rate developments. Affordable projects also face extended permitting, funding application, and compliance processes that can delay delivery and dilute the impact of increased funding. Speeding the entitlement process is a key component of building more housing. So I think this really gets at a nagging thought I've had about government-funded affordable housing for a while. We talked about this a little bit before with Multifamily Dispatch, and I'd love for you to chime in whenever you can. There's this idea that building affordable housing costs so much more than building market rate housing. That was one of the key points in the abundance argument. Was that, in some places it costs $1 million per unit or some insane number, a lot more than you would expect, a lot more than is feasible, some would say, to build affordable housing. But I think that this greater cost takes this kind of a primacy in the discussion that that shifts focus away from like other challenges in a way. I don't know if that's if this higher cost really is the entire story of why there's not enough affordable housing. I remember a series of housing initiatives and memos from the Biden administration talking about these enormous sums that they have earmarked for housing and building additional housing. And then maybe there was a few projects here and there to show for it. So it makes me think that sometimes it's not merely that the building costs a lot of money to build. Sometimes you can't find a place to build that building. You've got this money sitting there that you can't even spend it. The money's harder to spend. So that's what confuses me about this affordable housing, this part of the affordable housing discussion. The government spends a whole lot of money on a whole lot of things, and they're not always wringing their hands about whether a government building renovation, for example, costs too much compared to others. They kind of just do it because they're not really investors, and they're not trying to get a return on investment if they're building like a highway somewhere. They're just trying to put that money to good use. And that should be, if it's government providing the housing, then it shouldn't be like, well, let's just get it out there, because obviously that money's not getting out there right now. And what's happening is people aren't being housed. And so that's my sticking point.
Well, in the LIHTC program, low-income housing tax credits, there's tax credits that are the fuel, right? And so when you, on the one hand, increase the supply of tax credits available, you have to have someone to buy those tax credits.
Okay.
And the reason to buy tax credits is to offset taxes, right? So if you cut capital gains taxes at the same time, or having a situation where you're experiencing lower economic growth, or you introduce additional tax credits such as energy tax credits or other vehicles for corporations to reduce their tax liability, it reduces the demand for those tax credits. So the supply of them is great. We have ample supply of tax credits. What we have right now, though, is a lower demand for them. And so that's where things get stuck. If no one's there to buy, then there's no money going through the system in order to build.
Okay. That makes a little more sense. And that was how you explained it. And then I was like, what? Can't just government give the money? And then who owns it? And LIHTC is a nice solution because it allows the ownership to be private and incentivizes kind of the operation of the apartment building properly. Otherwise, like then the government would own and operate it, and that seems like a big can of worms that I don't know if they want to get in that business. It's like messed up incentives here. I also think it's interesting how they've got all these tax credits available, but people aren't there. Is that because corporations are already basically they've paid for all their tax credits, they're at zero, they don't need any more? Or could one, and this is something I'm just thinking of, could they increase the tax credits that you get for LIHTC? Not just, you get X number, but make them more attractive, each tax credit for each project, or is that?
Yeah, there's certainly a lot of ways to solve this problem, I think, and that's not the only problem, right? Another challenge is the entitlement process, and it's how each individual state has decided to award tax credits.
Yeah.
And some of them have really bizarre and archaic point systems that really may not make sense.
And are any of them distributed according to like the kinds of buildings that you're building or anything like that?
Yeah, these scoring checklists are, they're unique by state, and they are uniquely positioned to achieve the goals of the state agency, which may or may not be market goals.
This gets me back to my larger point is like, yes, some of the obstacles are money, and that there's not enough money in there, but then there are other obstacles, whether it's, people finding just the right person to give the money to, or just the right projects, or just the right place to put it, where it's like, all right, let's just get it out there. What can we do? Maybe let more places be, or more people be eligible. More, yeah. Open the eligibility to all these different, kind of projects and kind of people. That's great. I think that the this issue of the affordable housing space, it seems like it's getting more prominent, and people are talking about it a little bit more. And I think it's interesting from an investor standpoint as well. So I want to keep this discussion going, and maybe we'll get someone from Sullivan Development, closely connected to J+G Companies. I would love to. We'll continue that with them in the room, and they can correct every inaccuracy. But I'm going to edit this very good so that I sound really smart. But yes, this week really was great. It was great talking about the Fed and the state of the nation's housing. Like some weeks, we do get the best and juiciest news and research to discuss on the Multifamily Dispatch. And with the Fed meeting and the state of the nation's housing report, I think this was one of the weeks. But guess what? Every week is one of those weeks on the Multifamily Dispatch and the Multifamily Dispatch newsletter, which you can sign up for free at themultifamilydispatch.com. We cover the fascinating, important, and valuable news and data happen each and every week in the housing market and economy. I promise there's something juicy and interesting that happens every week. And Dan, we did it again.
Yes, indeed, Matt. Our listeners and subscribers know that we provide this curated multifamily data every week for free. But do they know why we do it? Do they know why we spend hours of our time doing this? And I think it's important to point out, at J+G, we acquire, we renovate, we manage apartment communities in the Midwest. And why should we have a podcast or a newsletter? Well, it's because we believe in the value of sharing our collective knowledge, sharing the latest news impacting our residents, our team members, our investors. And we believe this format provides added value to the people that we serve every day.
Yeah.
And that's what we do here. We add value. So thanks for listening and tuning in, and we hope to see you next week.